IT shares have been among the worst performers on the bourses this year as hawkish global central banks continue to risk global growth prospects. Amid rapidly rising fears of a recession in the West, the Nifty IT index is down over 30% so far this year, as against a 2% cut in the Nifty benchmark index. Top losers from the IT index include Wipro, Tech Mahindra, Coforge, and Mphasis, which have corrected 39 to 44% during this period. While the near-term outlook remains volatile, analysts still see the sector as a good contrarian bet from a long-term perspective. This, they say, will be aided by cheaper valuations and the sharp depreciation of the rupee against the US dollar.
I think if you are looking at year or year and a half, that is about 12 to 18 months, then IT remains a preferred idea. The correction that we have seen is a healthy correction, 30% almost on the IT index. I think the valuations have become attractive. So if you have a long-term view of, say, about 12 to 18 months, then you can definitely look at IT. The only thing is, since markets are into consolidation mood, don't put all your money at one time. Buy some right now, maybe about 25, 30, 40%. And the balance you can go on adding on dips. So we remain positive on TCS, Infosys, HCL Tech and Tech Mahindra. In the mid-cap universe, we remain positive on L&T Technologies, Mindtree, Persistent Systems, KPIT Tech and Tata Electric.
While some pressure could continue on IT companies' margins in the next few quarters, analysts expect this to improve by the next fiscal. This could be driven by reduced and/or frozen variable staff payments by companies to slash their employee costs. As per Elara Capital, the variable payout cuts hold the potential to lend material margin support. These can translate into operating margin support of 220 to 400 basis points for Infosys and Wipro. Further, consensus estimates have factored in an average EBIT margin improvement of around 80 bps in FY24 for large cap IT firms. Sharing a similar view, Apurva Prasad of HDFC Securities believes that the margins for the industry have bottomed out in Q1 FY23 amid moderation in attrition.
So we broadly have a constructive stance on the sector, and the positive view is also premised on some of the core verticals which are looking fairly okay, fairly strong in fact. So BFSI, despite all that's happening in macro, BFSI is looking fairly strong. So while there are macro risks which remain, but the commentary around deal timing, overall supply side related indicators, or if you look at some of the indicators from the most important partners, the large cloud platform companies, or some of the indicators from the large end clients of customers, those remain very okay. So I think the demand should be resilient despite the macro uncertainty.
That said, markets may exhibit volatility today on account of the monthly FNO expiry and the street's reaction to the minutes of RBI's last meeting released on Wednesday.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.